Hello, everybody, and welcome back. Impact investing that aims to bring about positive change in environmental, social, or governance measures is now an established investment concept. And yet, the differences are sometimes significant. I'm discussing these topics today with my guest, Duncan Downes. Duncan is a senior client portfolio manager on the positive change strategy of Pictet Asset Management. Warm welcome, Duncan.
Thank you very much. Pleasure to be here.
Duncan, can you describe what positive change means at Pictet Asset Management and how this is reflected in your investment strategies?
Absolutely. Well, as you said, there are varieties of impact investing, and positive change is a differentiated variety of that. And positive change for us really means improving impact. So improving the effect of a company's products and services and its operations on the world as a whole, on its society, and as you said, on environment as well. And here we assess that through alignment with the UN SDGs, the Sustainable Development Goals, because they're internationally recognized and crucially because they take a holistic view of what sustainable development means. So there's a real balance between environmental topics, social topics, and economic topics as well. The transition has to be economically viable. To be truly sustainable development, it has to be economically viable as well. And so we believe this is the right way to invest, to take that holistic approach and to look for improving impact because it's beneficial for society and the environment. We're driving improving impact. But most, we believe that this can be value creative for shareholders. For us, positive change is really a driver of performance in the equity markets. We're looking to invest in companies for whom the improving impact is actually a driver of improving returns. And that's key. It's not a nice to have on the side. It's not for our marketing. It's because it can actually be an alpha driver for investors. As companies improve their alignment with the SDGs, improve their impact as they have positive change, then that should also be value creative for shareholders. And then, of course, where we can, we engage with companies to accelerate that improvement. Because part of positive change for us is that we take, as investors, an active role in helping that positive change, in encouraging that positive change where we can. So it's a forward-looking and pragmatic approach to impact, hopefully with our involvement as investors as well.
So let's dive a little bit deeper into this. You already mentioned the SDG. So what are Pictet Asset Management's primary objectives with impact investing? And how does your team contribute to achieving these objectives?
So I'm focused on the positive change strategy in particular here, of course, Pictet Asset Management. We've also got our very successful thematic franchise who are sitting just the other side of this wall, and they take a slightly different approach. But on positive change, where we use the SDGs, what we're focused on is improving the alignment of a company's products and services with the Sustainable Development Goals. So we're not picking one, because they're all connected. You may find a very exciting healthcare company that's got obviously a very clear positive alignment to SDG 3, good health and well-being. You could find a food retailer, let's say, that's got a clear positive to SDG 2, zero hunger. But both of them may have negative alignments on the environmental side. The climate action, SDG 13, life on land, life on water. It may be that their packaging isn't sustainable, or their sourcing, or some other aspect has to be considered. So to only focus on one, to pick one impact category, could be ignoring other impacts elsewhere from that company. And so we take a holistic approach. So when we're talking about our primary objective, it's improving alignment to the SDGs, because ignoring those negatives, I think, is something we do at our peril, because we're looking for impact improvement. Reducing those negatives can be just as powerful as expanding the positives as well. So across positive change, in all of our holdings, we have leaders, improvers, and opportunities. Companies that are well aligned to the SDGs today, the leaders, those that are already on an improving trend, the improvers, and those opportunities, companies where we see the potential and the willingness to be aligned in the future. And we do that in all sectors of the market. So every investment is driven by an improving impact angle, increasing the positives and reducing the negatives. And that's if we can then encourage that to grow, to those negatives to become smaller, for those positives to become larger, accelerating, improving alignment to the SDGs through active ownership, engagement, and proxy voting, then of course we do that as well. Because, as I said before, it's a driver of alpha. So if we can encourage our primary objective, improving alignment to the SDGs, then we should be encouraging improving returns as well. And it should be a symbiotic relationship between the two.
I think this is a challenging one. So how do you identify and evaluate potential investment opportunities that are not only financially attractive, but also promise a significant positive social or environmental impact in the future?
They should be intertwined. So for us, the impact improvement case and the financial investment case should be intertwined. They are entirely related. So the improving impact of the company as it transitions its products and services, as it improves its operations, that should be value creative for shareholders. It's positive for the company's financials. It's improving its returns, and therefore it should see an improving valuation in the market as well. So the first thing we do is assess a company's alignment to the SDGs today. So we've built a proprietary tool. It's based on natural language processing, so a form of AI using unstructured text data to help us do that in a way that is independent. First of all, it's not me who's deciding if a company's activity is positively aligned to one of the SDGs. It's a database of scientific research. It's systematic, so we can do it for the whole of the MSCI ACWI without having to have a team of 100 impact analysts. And it's broad, because what I said before, we want to make sure we're looking across the range of topics that the SDG covers, and the tool allows us to do that. So looking beyond those obvious positive alignments to find the areas of potential improvement. And then we look at financials, because this is bottom-up stock picking at the end of the day. And we want to narrow down the world of equities into a manageable size of companies for proper research. And we want specific things within that. We want strong companies with established franchises, high barriers to entry, sustainable returns, and that have a positive or improving impact. So then it's about deep fundamental analysis. And again, it's a question of balancing financial due diligence alongside impact assessments, because the impact assessment should be driving the financial upside. So we look for material topics from our SDG alignment, first of all, and then backing it up with a framework by an institute called SASB. And then we assess the company's impact and its potential to improve that impact and whether that will be financially material for the company. And then we can model out our potential investments and include within that a blue sky impact scenario. If everything comes true, if this company transitions how we think it could or should, what would that mean for the future valuation of the company? And that gives us that balance between the two, because the two are very much intertwined. And then it's a question, of course, of how we measure that.
Can you share specific examples of successful investments that you have that have created measurable positive change? And how do you measure this change? How do you evaluate it?
Yeah, I hope you've got a long time, because I can talk for a very long time when we get into the examples. But yes, we can, because we're very transparent. So not only can we share some examples, but in our reporting, we share all examples with our investors, because we think it's really important when we're talking about impact as a topic to be very open about what we're doing and why we're doing it. So in the last year, Toyota, I think, is probably an interesting story, a good example for you. Most impact-focused investors would probably hold Tesla or BYD in the autos, the electric vehicle-focused companies, because the shift to EVs away from fossil fuel-powered cars, that has a positive impact. But Tesla sold 1.8 million vehicles last year. Toyota sold 11.2 million. So Tesla's a high end as well. Toyota's a mass market vehicle. So yes, there's a positive impact from holding Tesla. But if Toyota can transition, if it can change its business to be focused towards cleaner technologies, the scale of that improving impact is much, much larger. And so we've been engaging with Toyota since 2021, together with our Japanese equities team at PAM. And we've been encouraging them to increase the pace of that transition because they have the technology leadership in place. We know that they have been investing in this area. And with the new management team coming in last year, we've seen a real shift from the business. So they set a target to triple EV production, targeting 1.5 million vehicles by 2026. And they announced that alongside a really exciting announcement on solid state battery technology as well. And now as investors, we should never claim credit for what a company does at all. But if our engagement played even a small role in accelerating that change, if we encourage that change, encourage them to set that target that can focus the company on the transition, then we should do it. And I'm very happy to say that the market reacted very positively to that change and to that announcement as well. So that's one. Totally different would be our investment in Bank Rakyat, which is a bank in Indonesia. So Toyota is an opportunity stock for us. Like I said, it's a company that is less well aligned, but that we see the potential and the willingness to improve over time. Bank Rakyat for us is an improver. We think it's already demonstrating that improving impact that we seek. And we invest in it because of financial inclusion. It's a key sub-target, if you will, of the SDGs, particularly SDG1, no poverty, SDG10, reduced inequalities. So it's about bringing formal financial access to underserved populations. And Bank Rakyat is a leader in microlending. So the average loan size is actually below $200. And so they really do have a very positive impact on financial inclusion. So by growing this positive impact, by expanding the scope of its operations, Bank Rakyat can improve its positive alignment. So we track that growth. To answer your question about what we track the percentage of its loans going to microlending and the percentage of its loans going to small enterprises. We track whether or not those are first-time loans to see whether this is new people being brought into the fold, and whether it's therefore true financial inclusion. But we're also engaging, and it's a great way of demonstrating that everything is connected. We're engaging with Rakyat on something totally different, on biodiversity. Because in Indonesia in particular, given its incredible biodiversity there, this is a highly material topic. So we'd like to see Rakyat improve some of their practices around biodiversity, and so we track those metrics as well. So it's two very different examples, an automaker and a bank, and one really focused on environmental topics, one on social topics, but it shows the kind of positive change that we're targeting. And to measure that change, which is one of the biggest challenges within impact investing, we think you have to go bottom up. You've got to set specific KPIs for each company in order to track its impact and whether that impact is improving. And that way you can ensure that it's a material topic and it's a relevant measure for that company and for how it's changing.
Great examples. So thank you very much for bringing this. Duncan, how do you address the challenges and criticism often associated with impact investing, such as the risk of greenwashing?
It's a very real challenge, and it's something that we as investors have to be extremely aware of. And I honestly think the only way we can do that is to be transparent. Transparency is the answer here. How do we show what we're doing? Because greenwashing is saying that you're doing something and then not doing it. So we need to show that we are doing what we say. And how we do that is open and honest transparency in reporting. And so, as I said before, on positive change, we report every stock in the portfolio. We show its SDG alignment. We show why it fits within the positive change strategy, what our impact improvement case is. And we don't shy away from the negatives because we're looking for impact improvement. So if we can reduce that negative, that would be an improvement as well. And we show which KPIs we're tracking to measure that improvement case. So in a year, if that KPI is going in the wrong direction, we expect questions. We welcome that. Why are you still holding this company when actually its KPIs that you're tracking are falling? And on engagement, that's exactly the same. Lots of asset managers are talking about engagement at the moment. We set a very strict definition for ourselves on what constitutes an engagement. We meet with all of our companies regularly. We talk to them about ESG, but that's not engagement for us. Engagement is where we set clear and measurable objectives, a predetermined time horizon, and we communicate that to the company critically, and then we report on it. So in our engagement report, we show all of our engagement activity, even the ones that didn't work, that didn't make progress, that didn't go in the right direction. Because if we can show everything, our investors can see what we're doing and see that we're doing what we say we do. And I think that is the only way that we can counter the risk of greenwashing here.
ESG as an investment concept has now been around for a couple of decades. So what trends or developments in impact investing are you observing? And how are you adapting your strategies to the longer term future of this concept of impact investing?
It's an interesting one, especially at the moment. It's been a challenging time for ESG strategies over the last few years. And I think that, if anything, is sharpening minds. It's making people focus on what really can be value and impact creative within this world. And so we're clearly, first of all, very pleased to see that impact as a concept is becoming more mainstream. And we can see that in all of the data. We believe that all global equity investors should be looking at impact in the future. As I said before, for us, improving impact is a driver of returns. It's a source of outperformance. And so it should be relevant for all investors. It should be something that everybody's looking at. As I think today, aspects of ESG is becoming. It's very rare that an equity investor wouldn't be at least paying lip service to governance, but really focusing on governance. We know that if that can go wrong, there's a problem. But more than, we're really closely following the growing understanding that investing in the transition is important. And I'm really emphasizing that word for a reason, because the world of impact investing to date has really been focused on positive impact only. That's excluding sectors or companies that have a negative impact. And the regulation in a lot of countries is set up that way as well. If you think about the SFDR regulation in Europe, there's a do no harm principle within there as well. But investing is forward-looking. We need those companies to change. And we see that investors are increasingly realizing that just excluding is backward-looking. And arguably, it doesn't really drive change. We haven't seen oil companies struggle to find funding over the last few years by any stretch of the imagination. So we need to be forward-looking, and we need to be active as investors through engagement, through active ownership. And so we're seeing that transition or impact improvers or ESG improvers, this is becoming more of a trend. And clearly, we're very happy about that, because this is where we've built our strategy and we think it's the right way to invest.
That was Duncan Downes from Pictet Asset Management. Thank you very much, Duncan, for being with us today and discussing with us the concepts of impact investing and positive change.
Thank you.